Hey everyone, Couch Investor back to another video for today. So as promised, I'll cover GM's earnings report and why Wall Street loves it, but you definitely should not. Yes, it beat earnings per share estimates. Yes, it beat revenue estimates as well. The stock was up 10% last week, so that's all great. But despite all the fancy schmancy headlines out there that GM is back, is growing strong, they're leading the charge in the EV race, I say we as Tesla shareholders, but maybe EV enthusiasts as well, know that this is definitely not the case. Now I'll start the appetizer here with this right there. So a comparison between Tesla and GM, although it's not apples to apples because, well, one company here has free cash flow in the last 12 months of over $7.5 billion, while the other is negative. GM, on the one hand, it's the blue one right here. As you can see, Tesla has been catching up GM's revenue quite quickly in the last couple of years. GM's revenue the last 12 months was $156 billion. Tesla was $81.4 billion. Now, despite this huge gap in revenue, Tesla still managed to generate $3 to $4 billion in net income more than GM. Just putting it out there. Then, when you look at Tesla's return on equity and GM's return on equity, basically Tesla is double that. Tesla's gross profit margin is 25.6% in the last 12 months, while GM is 13.5%. And if we look at valuation metrics here, for example, PE to growth in the next 12 months, so not trailing, but in the next 12 months, GM is actually higher than Tesla. Of course, GM right now, forward PE is 6.7 times. Tesla is much higher. Well, Tesla is much higher because it's growing faster and is more profitable. If you want a definition of a value trap, shall I say, then maybe GM should be a prime candidate. Now, I know I'm sounding extremely bearish on the company and negative on the company. I might sound the same with Ford. Well, actually, I like Ford more than GM, but that's maybe a story for another video. But for GM, just because the headlights look great, let's say, which it usually does because, well, let's face it, the enemy here is Tesla. GM is the one and only. Let's back them up and say that they are the best and everything goes smoothly. Well, as you will see during this video, this is clearly not the case. I will say this, some good things might happen for GM in a couple of years. For example, that agreement with Lithium Americas, I think was a great move. But let's wait and see what happens when they actually will use this, because it will take some time. Now, we're going to have a look at a couple of numbers during the earnings report. Not all of it, because that will be way too long, but the most crucial ones, and then we'll conclude it and you will be the judge as to whether Wall Street is correct with going after, well, for GM and not really backing Tesla that much in the last couple of years, if we're being honest with ourselves. So stay tuned for that. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. I would really appreciate that. And if you want to support me and this channel even further, do check out the link down in the description and the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. So let's first start with a couple of highlights here. So first of all, US market leader, they're basically saying they are the best. Number one in total sales, number one in full-size pickup trucks, number one in full-size large luxury SUVs, and number one in luxury sports cars. Now, I will say, if I scroll up, maybe a bit more, I will say this looks extremely good. The Corvette looks very good. Now, as for the rest here, largest US market share increase of any automotive manufacturer, up 1.6 percentage points. Okay, we'll talk about market share in just a bit. Then secured all EV raw material for 1 million units of North American capacity by 2025, including more sustainable local sourcing. Great news, good to hear. Now here to talk a bit about the Chevy Bolt, which we know had a lot of issues, but of course you won't hear it that much in the news. Now I'll say this, Tesla is letting everyone play around right now because it does not have a compact vehicle. Once that so-called Model 2 comes out, it's basically game over. Let's just be honest with ourselves, or maybe even that Model 3 refresh might cost even less than the current Model 3, who knows? Then again, it will break the market just like it is breaking the market right now when it reduced its prices. What will the rest do? Not reduce their prices? Of course they have to reduce their prices, otherwise why would someone buy an inferior vehicle for more? Just doesn't make any sense. And of course, if they do decrease the price of their vehicles, then the tiny margins that they already had on those vehicles will become even smaller. So it's just a matter of time until one of these companies, well, figures this out and says, well, apparently we're in a difficult spot here. Now, circling back here to GM specifically, of course, we already talked a bit about that investment in Lithium Americas, investment of $650 million. Now, Lithium Americas expects the lithium extracted and processed from the project, which will only start, well, scheduled to start in the second half of 2026. So that lithium should support production of up to 1 million EVs per year. Now, GM will also have exclusive access to the lithium offtake in the first phase of the project, and apparently for the second phase of the project, they will have priority to make the first offer. Then when it comes to GM's guidance, so it's funny that they mention here other 2023 assumptions, 15 million US vehicles SAR. So what does that mean? Seasonally adjusted annualized rate, as a way of working out how vehicle registrations, be a new car or used car, are performing in relation to typical market trends. So of course, if they miss their guidance and this metric here is lower, then they'll say, well, that's because we assume that it was 15 million for the year, which again, you're basing your guidance on something else and not on your own projections of how well your company is doing right now. Now remember when we talked about market share, well, when GM said that its market share was the largest increase in all of the auto manufacturers out there. So in the United States, we went from 14.4% in 2021 to 16% in 2022. Okay, nice little increase there. But if we look at total GM market, it went from 9.3% in 2021 to 9.2% in 2022, so 0.1% here erased. Then total worldwide has not moved at all. 7.6 2021, 7.6 2022, which means fine, overall in the United States they gained market share there, but overall worldwide they haven't moved much. Not only that, the market worldwide has become smaller as well. So basically they have been selling less vehicles than before, which you will notice later in this video how that impacted the business. Because if we start with this slide right here, so GM North American performance, net revenue of $35.5 billion. Now, okay, and we know that deliveries for this quarter was 623,000, an increase of around 67,000 vehicles quarter over quarter. We also know that US dealership inventory is now at 411,000, an increase quarter over quarter by around 52,000. So, quarter over quarter increase in deliveries of 67,000, 52,000 increase in inventory, which means technically only 15,000 vehicles went to the customer. All the rest sits at the dealership. Now, if you look at this picture right here, of course, this was from November, but the story is the same here. You can clearly see that the green lines, which are GM-owned brand, have significant amount of inventory. Now, this is fine where things are okay. Also, by the way, Q4 is usually the best quarter, the strongest quarter out there. Q1, not so much. So what happens when these dealerships suddenly either don't sell the cars and, well, their parking lots are filled with cars, or maybe they do sell the cars, but they sell it at a loss or not really at the prices that they thought they would sell them? What happens in Q1, in Q2, in Q3 of this year? what will they say to GM? Will they still accept all of these vehicles just so GM could report, well, we sold those cars, those are revenues? Or will something else happen? Because this really is the big story here with companies like GM that still work through dealerships. It's fine to push all of that to the dealerships, but what happens when their dealership just can't sell your cars anymore or have to sell it for less than what they thought? That's the question that not a lot of people are asking, and maybe we'll get some answers in Q1 and Q2 when we look at the earnings report. Now remember at the start of this video we talked about net income, the difference between Tesla and GM, and then the revenue difference as well. So you can clearly see it here. Net income attributable to stockholders. 2021, just over $10 billion. 2022, just under $10 billion. Of course, not such a big difference, but overall, this is down. But yes, if you scroll down, you see that EBIT adjusted, it is up a little bit year over year. So no, things aren't that great for GM when now they can barely grow as much as, well, the headlines say. And if they're looking to make excuses, you can scroll here to page number 10 of this report. You can clearly see here, North America capacity to shift utilization. So in 2021, they could have made the excuse we're just at 78.4%. But in 2022, you're closely to 100%. So what's happening here? Less cars sold, but more people to work. So what's going on here? And by less cars sold, it's clearly written here, right? Total worldwide right now, just under 6 million. Last year, 6.2, close to 6.3 actually. And now before I conclude, I do want to touch on this right here because yes, I do think you can think of it both ways. Now when I'm talking about automotive, Cruise, and GM Financial. Of course, if you look down here, you can see income before income taxes, GM Financial, just over 4 billion. Automotive, 10.7 billion. So combined with the Cruise being at a loss here, combined $11.59 billion, which means GM Financial is approximately 35% of the income here. Now, yes, some people might say, oh, that doesn't make any sense. I thought GM was a car maker, but 35% of their income here comes from GM Financial. Just doesn't make any sense. Well, true. That's true. You can make that point. But then again, if you are someone that has, I don't know, Tesla shares, well, we also have automotive. We also have energy. We'll have FSD, recognized revenue, then have insurance as well. In the future, maybe, I don't know, robotaxi, etc., robots, and so on and so forth. So it's fine to have multiple streams here of revenue and income. But in this case, of course, right now, being called the leader, the whatever, GM Financial being 35% of the income is a big deal that, well, apparently nobody really wants to talk about because the automotive part of the business isn't doing that great right now. And so to conclude, although Wall Street, the government, they all love General Motors, they all want you to think that General Motors is doing extremely, extremely well. Hopefully this video served as, well, the contradiction as to show you that, well, things aren't that great for GM, and no, they're not catching up to Tesla, but that's just me. This video focused on GM. Of course, if you're a GM shareholder or whatever, do share your thoughts down in the comments below. And if you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.